Today, folks, let's take a minute and talk about pull forward valuation, the AI bubble, my positions in companies like Tesla, and how I feel about the recent rally. If it's a conversation you appreciate, just hit that like button. If you're on a path to financial independence, perhaps one day retire early, consider subscribing and joining me on that journey, because there's been analysts out there claiming that the S&P has a lot more room to run if we are truly in a bubble, because if it's comparable to the dot-com bubble, we are nowhere near yet to the same kind of valuation metrics. This is where Tom Lee, all these people are getting super bullish. And as mentioned, I honestly think around a 30 times multiple is incredibly justifiable in the current market environment. If you believe that we are in a technological revolution, a true period of margin expansion over the next 5 to 10 years, we continue to see double-digit revenue growth out of the Mag 7. There's no reason to say that we're overvalued today. Now, it's going to lead to a lot more excessive volatility, because obviously the past performance doesn't equal future return. And when the future doesn't exist and we're relying on where the future is going, it's going to lead to a lot more turmoil within the market environment. So just kind of keep all of that in mind as we take a look at some of my positioning and discuss some of the valuations on these different companies, because recently, as many of you know, I've been cost averaging in Tesla. I have an average price of 100 shares at $186 per share, and now we're sitting at like $230, which my spreadsheet hasn't even updated the current price because it's been so volatile the last couple of days, and people are like having a hard time wrapping their head around how a car company that, if you just look at the recent deliveries being 443,000 with a production of 410,000, meaning they're selling more cars than they're producing, which means they had back-end inventory they've been trying to get rid of. And if you only go 1 year back, they were making more cars, about 480,000 cars, and selling about 466,000, which means they had more demand than they had production available. Now, this should be very bearish for a stock like Tesla. So why is it rallying so aggressively? Well, firstly, they beat analyst expectations because they thought it was going to be a lot more abysmal than it was. You have to recognize that we are in a much tougher market environment than we were a year or two ago, thanks to interest rates. I mean, even companies like Apple are currently struggling. I mean, outside of Microsoft, if OpenAI can go public, Microsoft has so much room to grow. NVIDIA, there's just companies that have been able to take advantage of, either software or business-oriented revenue, B2B and not consumer revenue. Because let's use Apple as an example, because Apple right now is even pulling forward some of its growth potential. Because how is Apple up 18% this year against a 34 times multiple when their revenue hasn't done anything but downtrend? That's because they think AI is going to pull forward a new generation of iPhones that are going to require a lot more upgrades and value creation, which is going to lead to better growth in the stock. So that's what's happening across the spectrum of all these companies right now, right? When it comes to Tesla specifically, you have to imagine that the times that we exist in today aren't going to persist in the future. Same with Apple. Like, everyone's imagining a future where these companies' prospects are going to start to come into fruition. Self-driving, robotics, all this AI stuff, right? So if you like these kind of companies, you have to recognize that you're going to be paying a higher valuation for them. So with Tesla specifically, I told you guys that, I am very comfortable buying the stock in the $150 to $200 range, presuming the fair value is closer to $80 to $100 a share. The problem is when companies have so much pull forward valuation, they'll never be trading at fair value. Cult following or not, it doesn't matter. All companies will trade well above their intrinsic value if there is some kind of huge prospect into the future, which is why when you look at valuation metrics on value calculators, they don't exist to make sense. It's all fugazi. You can't look at the past and present the future. Now, you could potentially do that with companies like Procter & Gamble, very stable, boring dinosaur companies, but with the Mag 7, you can't do that. You have to presume there's so much going on into the future that those are going to be massive value creation, opportunities. So for me, when I look at a company like Tesla, everyone's like, oh, it's overvalued. It's this, that. It's okay. What's fair value for a company like Tesla? Probably $80 to $100 a share. That would be, I think, where the intrinsic value would be underlying. The problem is we'll never get there. So the idea to me is I'm comfortable buying it in the $150 to $200 range, presuming that it could drop 50%. And if it does, I'm comfortable buying it down there because I'm prepared for it, right? Same like buying the S&P. You're going to buy the ebb and flows of it if it's a company you truly believe in. And I think it's interesting, too, when you compare a bunch of different companies and the hype within these companies, because Tesla, was generating an odd $31 billion in 2020 to merely, 3 years later, almost generating $100 billion. For trading around a $600 billion market cap, you're trading at 7 to 8 times roughly revenue currently, right? If we're using revenue as a pure valuation metric, which you can't, because you want to pay attention to gross profit, earnings, cash flow, all that garbage. But right now, let's just use revenue, because there's a lot of smaller cap companies that are getting a lot of hype right now, like Palantir, which, similar deal, has a lot of pull forward valuation in it, trading at a 205 times multiple, a $58 billion market cap. If you take a look at the growth going from, 1 billion to 2.2 billion in the same time period, hasn't even seen the same revenue growth as a company like Tesla has. And, they're trading at, whew, man, 20, 30 times, revenue compared to the current, market cap. So when you look at a bunch of different metrics, it's really hard to actually pinpoint what the value is on these variety of companies, even Apple, right? Like there's just so much going on that you kind of have to take a breath and recognize that you need to be very cautious in this market environment with what you're doing, which is why I so heavily recommend cost averaging into the S&P, the Qs, because I think technology is the future. I don't know how much growth we have ahead of us or behind this. Anyone that tells you they know what's going to happen tomorrow is a complete and utter bullshitter. You just have to recognize that you got to pick a few companies you love. You have to be very patient with the volatile market experience that's going to persist. And you just have to not stop buying. At the end of the day, just you cannot stop buying in a market environment like this. Like the returns in my portfolio are kind of getting a little nutty. Even for like my, experience, I'm like, this is insane. It makes you want to take profit. But you have to recognize there's so much more that's going to happen in the future. And as I mentioned with the S&P in past videos, I told you guys, if you look at the peak and trough of the S&P valuation, I mean, it peaked in June, it was like December of 2020. That's when the valuation peaked at almost a 36 times multiple. And then by basically, June of 2022, it dropped to a 20 times multiple, which was more favorable. But if you take a look at that period in the S&P 500, I think you'd be blown away to realize that you could have never predicted the tops or the bottoms, because in December of 2020, when the multiple peaked, the market still was able to run by 22% because there was so much, revenue growth and profit because of helicopter money from the government. And then the interest rate cycle started to begin. And basically we had to wait till June, was it June of 2022 before the valuation like finally settled out at the lowest of 20. And during that whole period, I mean, the market rallied excessively. And if you bought the peak of the market back then, you'd still be up almost 50%, right? And I think that's going to be true for most companies. Like Tesla, people are shocked that it's rallying so much. But I don't know whether that's because of the cult following, because, people are changing their opinions on self-driving. You don't really know, so you can't anticipate it. All you can do is believe that these companies have a huge future with their current technologies, and you have to be willing to hold on to it for 3 to 5 years. And that's essentially my plan with Tesla still, unless it does something absolutely insane, because like I said, when I get these rallies in such a short period of time, it does make me want to take profit on the company. But unlike Google, because I've mentioned I sold Google at a decent profit this year because I just don't believe as thoroughly that they're going to be able to scave through, at least with it. You're kind of gambling, right? Like with Google's business, over 50% of the revenue comes from search, Google search alone. My fear is Google search has peaked, and that if they start losing a significant amount of revenue share because of ChatGPT, all these different search softwares that are coming out, if it declines by even 10%, it could detriment the stock dramatically, right? So that's my fear with Google while they work on all these other businesses. Whereas Tesla, I think they've crashed enough. I think the auto business will start to recover once the interest rates come down. I think 2025 will be huge potential for self-driving and robotics. So I think there's still a lot of future growth potential with a lot of moats that are undisruptible, whereas Google can be disrupted. I think Apple has an incredible moat and was a great buying opportunity this year, though I think that buying opportunity has surpassed us at a 34 times multiple. Microsoft today, I think, still has some great potential if OpenAI comes public. That's why it's able to command a 40 price to earnings multiple. OpenAI, it might not be here in the next 5 or 10 years. We'll see. Obviously, search and AI is becoming a very competitive market. And just like MySpace, you don't know how these early adopters might not be around in the future. Nobody really knows. So I think there should be some valuation. I think they should recognize the value. I think they should bring OpenAI public, recognize it for Microsoft today, because that's the only way to justify a 40 times multiple. I hope it comes back down, but either way, there's going to be a lot of volatility, a lot of ebb and flow. And I told you guys, we're in a brand new market environment. It's not the market that we were in from 2009 to basically 2020. I think you're going to see a lot of ups, a lot of downs, but all of it's going to continue to the trajectory will continue to be up and to the right. These are just my personal opinions because, again, I don't think we're in a full-blown bubble yet, but who knows? I'll pass that question off to you. I'd love to know what you think in that comment section below.